Hello and welcome to DeFi 2.71 podcast. This is Seraphim, and today we've got Allan from Yield. Hey.
Hi.
It's good to see you. How do you enjoy London?
Yeah, London's been great. It's a great city.
I think the last time we've seen each other was in Palm Beach, I think, right?
That's right. It was a good time.
Yeah, London, Palm Beach, the life of the bear market life. Yeah.
I know, it's been really bad. Well, thanks for having me, Seraphim. This is great to be here.
Sure, absolutely. Let's chat a little bit about you. How did you get into crypto? What did you do actually before you got into crypto?
You know, before I was in crypto, I was actually a patent attorney. So completely, non-crypto field. And my job was to, help inventors protect their ideas from copying. And the cool part about the job was that you got to work with all these entrepreneurs who had a vision of how you could make the world better, through technology. And I was always drawn to that. I always thought that was cool. I think that sort of was that enjoyment of that was what led me to and excitement about that is what led me ultimately to Yield. But of course, it was a long, winding path to get there. My journey in crypto, I think really actually started, before I was even a lawyer in a sense, before crypto existed. I graduated from law school in 2009. And, that was in the middle of this global financial crisis and recession that had occurred. And it was really, I think, formative for me to just see the power that the financial system, had over all kinds of people's lives, and my life and my friends' lives. I mean, we were going to law school. We thought we were going to, graduate into this incredible market, for lawyers, and there would be all these jobs and stuff. And then just this financial crisis occurs, and everything changes like overnight. And people didn't get the jobs they expected. They were underemployed. It was kind of a rough couple of years. I was just, I think it made me much more cognizant of finance in our lives. And so then when I heard about Bitcoin, pre-Ethereum, pre-DeFi, back in 2011, actually, so ancient times, I would just was obsessed with it. I thought this is incredible, like the power of these blockchain technologies and things to, that this promise that they had to be able to improve our financial lives just really spoke to me. And so, even though I was a patent attorney, I was like, well, I want to get involved in that ecosystem. And so, I really sort of just started slowly moving in that direction.
Makes sense.
And what actually got me into the ecosystem was I wanted I knew I wanted to build something. I felt like building was the interesting thing about it to me. So there was a new cryptocurrency coming out. It was called this is in 2016. So years after I bought a little Bitcoin and kind of fell down the rabbit hole. There was a new cryptocurrency was coming out. It was called Zcash, and they had a new kind of proof of work that they were doing, which was really interesting to me. And so I built a cryptocurrency miner, so a way to mine that cryptocurrency that was kind of fast, at least compared to what had been publicly suggested would be possible. And so I took what I developed, that software. I went to go work for a very large cryptocurrency trading firm in Chicago and built a cryptocurrency mining operation. So that was sort of how I jumped into that world, which was completely different than the legal world I was in before. So it was a big change for me, but it's also surprising to a lot of people. I didn't know you could do this. And, you're jumping from law into trading and cryptocurrency mining. What is this? It's nuts. But it was in retrospect, just an incredible move.
It's kind of interesting how you started with the global financial crisis. It affected my family as well. We almost lost the house, everything. So it's I guess through that crisis, that's where the vision for Bitcoin came from, right? So
Right.
basically through pain. It's not for good times that people came up with cryptocurrency, right?
Yeah. I mean, yeah, for sure. I think Satoshi. Well, we don't know who Satoshi is, but I think he or they or whatever have been working on this problem a long time. But the confluence of it coming out at that same time that this global financial crisis happened, I think everybody was primed to really like see the value in it. Even though it did take quite a while for it to take off. I mean, quite a while, a few years, but
Yeah.
um, and I think we're now seeing a lot of that. We're in the early stages still, but I think we're seeing some of the fruit of that beginning to bear.
Yeah. Right. Let's talk a little bit about yield. So what's the story of yield? How did you come up with the idea? What led you to it?
Yeah. So yield, at least my part of the story started, I would say like in 2019. Um, I had been, I had started using a protocol called MakerDAO, which I think most people who know anything about DeFi are very familiar with. And, you know, it was like really the first borrowing and lending platform in the space. And I had used it to, I'd put some collateral in, minted some DAI, and I had borrowed it. I don't recall what I did with it. But at some point in early 2019, interest rates on DAI, in their protocol went from like 2% to 20% in the span of like a month. Um, and it was sort of shocking to me. I'm like, this is crazy. Like, like it's, I was paying this, now I'm paying this other thing, and this is really expensive, and the only sensible thing to do was to close the loan. Um, and I was like, for the future of finance, this doesn't feel great. We really need some sort of way to like borrow at a fixed rate. And, I wasn't alone, I think, in thinking that. I had a friend who actually worked at, or, was working with MakerDAO, and he's like, oh, we really need, fixed rates in this ecosystem, but the way everybody was thinking about it was like, oh, we need interest rate swaps. We need interest rate swaps. And I was like, personally, I don't really know how to use an interest rate swap or, like to think about that. I just wanted a fixed rate loan. And so, there wasn't a way to do it. And so I set out like, well, okay, well, maybe there's a way I could do this. And, you know, uh, I love the building of software, and I think it's fascinating. So I sat down. I wouldn't say I'm good at it, but I sat down. I started learning Solidity, the programming language of Ethereum, and I just started building, and trying out different things. Um, and around I would say like September, a partner at a research firm called, or it's not research firm, a venture capital firm called Paradigm. Dan Robinson released the first version of the Yield Protocol white paper. So, where he laid out the vision of what we are doing today. And, it was very close to what I was already, kind of how I was already thinking about it. And I just was like, this is, but it had some insights that I didn't have. And I was like, this is right. This is what we should do. And I think I pretty much just like, jumped on like a Telegram AMA with him and took it over and just like asked him a million questions. And, kept talking with him. And like that weekend, I, built like a prototype of what Yield Protocol could be. And he was, very supportive of it. He really liked it. And, we just started working together, kind of contemplating, how you could build this thing. And that led to the original, Paradigm getting involved and, incubating Yield Protocol, and then a seed round.
It's kind of funny how both you and Dan Robinson come from extremely different backgrounds. Like it's. Like,
he's also an attorney.
Yeah, right. Exactly. Yeah, you both come from law, right?
Yeah.
So, that's really interesting.
Yeah.
Did that help work together a bit, or it was relevant completely?
I think it does help a little bit. I mean, there are some ways that lawyers think that, especially lawyers who are also programmers think that maybe made us, has made it easier for us to work together. But, I mean, I think also he's just an incredible human being and just probably one of the smartest people I know. So.
And now that I think of it, like smart contracts are kind of like programming and a bit of law, right? So I suppose I see it's more connected than we think now.
Yeah, I think that's right.
Could you tell us a little bit more about like yield mechanics? What does yield exactly do? what are the mechanics underneath? You know?
Yeah, so yield is a decentralized protocol for fixed rate borrowing and lending, and specifically collateralized fixed rate borrowing and lending with fixed terms. And what do I mean by that? You can come to yield, and then you can deposit an asset, and it's on Ethereum and the Arbitrum chains. And you can come to yield. You can deposit something like Ethereum, and then you can borrow another asset like USDC, the dollar stablecoin, or DAI. And you do your loan is essentially for a fixed term, so it would mature on a future date. Like we have maturities; they tend to be quarterly, so it'd be like September or December. But when you get that fixed rate, you're locking it in until that maturity date. And then after that date, you can come pay back the loan, or roll it to maybe another maturity date. But it for that period of time where you have that until that maturity date, you have a fixed rate. You know what your costs are going to be for that loan.
Yeah.
So, I mean, do you want me to explain how it works?
Yeah, exactly. I was about to ask.
Great. Yeah.
How does that work?
I can kind of see you thinking that. So the way it works is, you put your collateral into the yield protocol, and you mint a new class of tokens that we call FI tokens for fixed yield tokens. And FI tokens are kind of like normal tokens, except they have one additional property. If you have a FI token, it has that maturity date. It has a future date on which it becomes redeemable for the underlying asset. So if I have, one FI token for, December of 2022, come December, I can redeem that token for, 1 USDC or whatever. And so that special property allows you to create a fixed rate loan. So, I put in my ETH, I mint these tokens, and then I can sell them at a discount. But that discount implies a fixed rate of borrowing. So it's a very simple mechanism. I mean, I think there's some subtlety to it. But these FI tokens are essentially like a zero coupon bond. For people who are familiar with that from traditional finance. So that's the primary way you borrow, you deposit collateral, you mint these tokens, and then you sell them. We actually built a whole marketplace for trading these FI tokens. I think that it's really cool. I mean, I think it's there's maybe a handful of original automated market makers in the ecosystem, like Uniswap. And our yield space market is one of them. And I think it's especially cool because it was the first to take into account time in pricing the asset that's being bought or sold.
So have you built like your own AMM basically to trade these tokens? And if so, how does it kind of work?
Yeah, absolutely. Like, the AMM lets you trade the FI token against the underlying asset. So if you have a FI token for USDC that matures in December, right? Then you can put that into the liquidity providers would put that asset into the AMM along with the underlying asset, say USDC, and users could then trade against that market to either lend or to borrow.
And like the MM itself, is it like UniV3? Is it like UniV2? What kind of...
Well, it's that's the cool thing is it's entirely new. Like I think there's nothing quite like it. I mean, we went back to and so the work that I did on this was with Dan Robinson and Lev Livnev, one of the early creators of Maker, and the way that it works is, or the way that we built it was, you just kind of went back to first principles, like literally, like how do you price a zero coupon bond, and can you take that pricing mechanism and then create an equation out of it that lets you sensibly build an automated market. And it turns out that you can. Actually, there's no reason, I think, to think beforehand to expect that's possible, but it turns out it is possible. And there's lots of assets where that's hard to do. But it just so happens for this particular asset, you can do that, and it actually creates a market that is fairly capital efficient, and becomes more efficient as you approach maturity, which is the sensible thing to do. It's a really cool piece of technology, um, and it's actually been adopted, I think, by several of the different fixed rate protocols also in the space. Like, I mean, we were the first to use it, but Elements used it, Sense used it. There's others that are planning to use it. We're really proud of that design, that technique, and I think it's going to be a fundamental part of helping to bring fixed rates into DeFi.
Speaking of that, like, why do you think fixed rates in DeFi haven't yet taken off? Because I think I come from traditional finance background, so obviously fixed rates are probably the biggest market. Swaps and cash bonds and everything, they're crucial for hedging, for everything. How come it's not a thing yet in DeFi? Like, what's blocking it, you think?
Well, I think you're right. First of all, like, I think you've exactly identified that there's this sort of mystery here, right? Because if you look at traditional finance, the bond market, right? It's something on, the global bond market is on something like $100 trillion, just enormous, and you can compare that to the size of maybe the global equities market, which I believe is maybe $50 trillion. I mean, these all might have come down recently, but for orders of magnitude, perhaps. So maybe it's twice as big as the bond market is twice as big as the equities market. And then you go to DeFi, and the comparable asset classes, the comparable equities asset class might be, the tokens like Bitcoin and Ethereum, but and also like maybe DeFi governance tokens and things like that. And that might, I think that peaked at like maybe $3 trillion, and it's down to like $1 trillion. Whereas if you look at DeFi and or bonds in the ecosystem, it's, if it's 100 million or a few hundred million, that's maybe a lot, So it feels like there's this big hole, like there's this missing asset class. And why is that? Well, maybe there's several reasons, like, first of all, just, the structure of the industry, right? Like, I think that, like, or where the players in the industry, maybe that's a better way to describe it, because, I think that a lot of borrowers in the ecosystem haven't really been interest rate sensitive, right? Like at least in this previous bull cycle, like people have been willing to borrow, at whatever rate, like they don't care, because, where they're going to tend to use the capital would be in some yield farm where, you're trying to earn, 50, 100% a year or higher. So they're just that level of interest rate insensitivity, meant that fluctuation in interest rates really didn't matter. So I think that's part of it. I also think that, a certain lack of maturity that goes along with that in the industry, meant that,
like literally maturity,
literally maturity, like
it's a funny pun. I like
it. People really don't. I don't think they have an appreciation for, or maybe didn't have a need for, being cost conscious about interest rates, or being sensitive to the volatility of interest rates. I think that's going to change. I mean, I think that is changing. And I think as the DeFi ecosystem matures, you will see, more and more demand for fixed income products or fixed interest rate borrowing in lots of different places, and that will allow the protocols like ours and others to I think it'll really start to supercharge them. So we're really optimistic about where it's going to go, and I think that like many things in the ecosystem, it's like it's more a matter of time than like if it's not this year, then maybe it's next year or in a couple of years. But I don't think it's a matter of if. Like, I think it's going to happen.
So to sum up, do you think the reason why people don't care as much is because when they get liquidated, that's because of pricing, not because of interest rates?
Right. It's because their collateral went down, not because
Right.
they've accumulated too much interest.
Right. So the assumption is then that volatility will somewhat decrease, right? So that interest rate impact is going to be more substantial, or like because I had we had the CEO of Vaults the other
Mhm.
time, and he made an interesting point that there's not as much DeFi versus CeFi integration yet, and CeFi will eventually definitely need to kind of hedge their stuff. So maybe the hedging activity is going to drive this kind of stuff, or I'm just speculating basically.
Right.
Like, what do you think?
I think use cases will drive adoption. That is, there will be users, I think, who will need this. I think one, maybe the nearest or maybe near future user, I think, of fixed rate in the ecosystem will be DAOs. That is, I think DAOs are going to start borrowing, to meet cash flow needs and, maybe to pay salaries or whatever. And they will be, I think, they'll want to control that interest rate cost. I think that they won't, for budgeting reasons, if nothing else, they won't be as excited about being like, okay, well, we'll have a loan where, the interest rates can be whatever, or can be quite expensive. I think they'll just want to kind of know, here's what we're paying for interest, and here's how we manage our budget over time. So I think that may be one early use case. But I also think, I think as the next generation, or maybe the next bull market of crypto arrives, I think that like we probably won't see as maybe I'm wrong, but maybe we won't see the crazy level of returns that you could get even in that next cycle. It'll be maybe more reasonable. Well, one could hope, and that would maybe make people more sensitive to how taking advantage of opportunities and being involved in things is enhanced by being conscious about the cost of capital.
Yeah, that's an interesting point, basically. So yeah, as we mature and we stop skyrocketing by 1 billion% every cycle, people would just be more sensitive to interest rate fluctuations. That's going to be the leading reason for liquidation, maybe, potentially, or at least the ratio is going to change a bit, and that will drive the kind of interest in fixed rates.
I think that's very possible, but I think ultimately, I think the analogy with traditional finance and the utility of fixed rate and fixed income products in traditional finance, I think just shows the path that will go. Like, eventually there become, use cases and needs where this is important. And the goal is to be prepared to just accommodate them.
One other point, though, is like in traditional finance, you have bond markets for real world use cases. Like you have a mortgage portfolio, right? And you want to hedge it. Or you've got some sort of what the government has used bonds for real life activity. It seems like in TradFi, as much as we don't like to admit, a lot of the finance underpins actual real life kind of economic usage. DeFi doesn't seem to have that yet. Like, do you think that's related to rates? Like once we have like metaverse mortgages, maybe that's going to drive a bit more usage, or?
Yeah, I mean, I think that, well, I mean, so first of all, I think some of that traditional financial activity will come into DeFi. I think it's a matter of time. Where and when and what will be first use cases, I'm not sure, but I think we'll find that there are, traditional external uses that will work their way in and will be useful. Maybe it's like corporations borrowing on the blockchain or something. So I think that'll happen. But I do think that there's actually going to be what I think is surprising is the level of new activities, like you've said, like metaverse mortgages that will kind of come out of nowhere that I think are also going to be incredibly important, and will unlock new ways for people to create value that we just don't expect. I mean, I think when you think of like asset classes, right? We're talking about like mortgages, right? One of the largest asset classes in the world, and this goes back to my background, is intellectual property, for example, right? Like owning ideas effectively. And, it's an enormous asset class. Now it's not an asset class that, maybe you're putting into your 401k. So most people don't think about it all the time. So it's mostly owned by corporations, but it's really, really large, and it's really, really valuable. I mean, corporations spend a lot of money on patent attorneys and protecting their intellectual property and, trademarks and copyrights and so on. And I think that, we're already seeing asset classes, native DeFi, our crypto and Web3 asset classes, like NFTs, for example, that have the potential to be very, very large and very, very important to people. And, I think it's kind of shocking to me how much like NFTs have become part of people's identity, who maybe don't even think of themselves as necessarily like crypto people. But, really, I think appreciate, the culture of whatever project that they're part of.
So I remember that indeed Element are different from you because they have a yield stripping element to them, right? So Notional is the closest probably in terms of like how you guys work, right? So I assume you're more like a lending protocol in and of itself where you can leverage up on your positions, right?
Right. I think that that's an important place to start for the ecosystem, because I feel that like, going to derivatives first or building things for traders first, I think it misses the boat. Like you're hedging something, you have to have real economic activity to hedge, right? And so I guess our goal is to create that real economic activity by creating and encouraging fixed rate borrowing. And so, we've tried to create this like very versatile platform so you can build on top of it, and, you can build, interesting things with it, through some combination of, new types of collateral effectively in the system, or new assets you can borrow and lend.
So what kind of collaterals you have on the yields?
So right now we have, on mainnet, we have like, basic things like ETH and some governance tokens. I think we were the first to add ENS, for example. We have things like, yield bearing assets. So, we currently only have like, I think one from Yearn, but we can in theory add them all. We have, other yield bearing assets like, a lot of, in the previous cycle, a lot of the ways that people would, yield farm was also often based around curve and convex. So, you can use convex like positions in yield, and then, borrow at a fixed rate to lever up in those. And then we actually, like are very interested in creating an economic efficiency. So, we want to be people to be able to arb with us. So we actually, you can actually arb notional against us by using notional's Fcash as collateral. And then we're really excited. One of the things we're going to add very soon is Euler e-tokens.
Oh yeah, nice. I like that.
So, I think that like our goal is to be able to add, anything I think that like, has real organic demand to be used as collateral, where fixed rates I think would improve, that borrowing use case.
In terms of the actual interest rates, like let's say you have 3-month maturities, right?
That's right, like 3 months and 6 months.
3 months and 6 months. I don't know if like, can you compare them to the other protocols? Like, what are the interest rates across the board? Just because I haven't been able to.
Yeah, in terms of fixed rate protocols, I think we're there's because there's an arb between us and notional that's been closed. I think we're close to them. I don't know where the interest rates actually are today. Like I haven't checked, but it generally seems to be kind of like TradFi in the sense that longer dated maturities tend to have slightly higher interest rates. There's an upward sloping yield curve. That's what I would expect. And our goal is to like continue to sort of extend out the maturities, and extend that yield curve, so to speak. As there's more and more demand for those long maturities starts to arrive.
That's quite cool. So it's being effectively arbitraged away, the difference between notional and yield.
Right. Yeah. When we added that, I think like we were surprised how fast it was closed.
Yeah, because in Euler it took some time. Like we had like some really wacky rates. We had like if I was doing the bull market, we incentivized borrowing, so liquidity mining drove lending APYs higher. Not because you actually get Euler from lending, but it just drove it. So we always had like a premium APY, but after the bear market kicked in, it just stopped carrying that much, and it just all normalized completely. But I guess the difference is with variable rates, you don't really hedge much, right? I think like you hedge, but at the end of the day, like I think with fixed rates, you arbitrage them, and you lock it in basically. I think with variable, you probably don't, maybe. Like,
yeah, I don't know how that would be done. I think I'm actually really excited about.
Yeah.
I'm really excited about all the ways yield protocol and Euler can work together, and like cool things we can build on top of each other. So we're adding Euler E tokens as collateral, which would essentially allow you to, make a bet that the floating rate of return on these E tokens would be higher than the fixed cost of borrowing over like a period of 3 months or 6 months.
Right.
So I think that'd be really cool, and you could do that maybe with some significant leverage, perhaps. So it's almost sort of like an interest rate swap.
Yeah.
And you could, in theory, go the other direction, right? Like we could let you borrow Euler E tokens and then effectively go short fixed rates, maybe kind of like a interest rate future on Euler interest rates, which would be really cool.
So let's say you lend USDC, you borrow EUSDC, you sell. Well, you can't sell. You like put it back into Euler, or what? Like how do you leverage up on that position?
Yeah, I mean, so you would let's see, you'd probably be depositing a bond, maybe one of our bonds. So let's say you've purchased one of our FI USDC, a bond representing the future payment of USDC. You could then put that into our system and then borrow maybe E tokens against it, right? Nice. And then I think you would just unwrap the E tokens. You'd take out the USDC, maybe to pay off the initial loan you used to buy the FI token. So in theory, you could do something like flash loans to do this with some significant leverage.
Right. So you're long the fixed rate and you're shorting the variable rate token.
That's right. That's right.
That's right.
So in that case, yeah, and that might be a really good trade even today, because if the fixed rates are higher than the floating rates, you could maybe make a pretty good return. Of course, you're taking some real risk, because if there's a spike in interest rates, say because of liquidity issues, you could very easily blow up.
Yeah. So you're shorting like liquidity risks or some sorts. Oh, that's pretty cool. Like,
yeah, I'd love to do that. I would love to build that, and maybe we'll get there soon.
Yeah, or doing the opposite, where you bet on the squeeze in liquidity. It's kind of like trading the cross currency basis in TradFi, where you bet on like liquidity squeezes. So this is pretty similar. It's quite cool.
Yeah, and I think the one thing that we've tried to do with yield is since we have this like relatively open, relatively easy to evolve system, I think we can build things like that with, without a huge amount of investment of effort at this point. Like, and we're just trying to like find, okay, which one of these things is that are people looking for and would really benefit from.
I think one thing that people would find interesting would be wrap staked ETH or staked ETH stuff, because I feel like there's actual institutional appetite there. That's pretty big. It's kind of like owning a bit of a network, or like getting the fees from the network, which is real and underpins everything. So I think from what I've seen, there's lots of institutional interest in this.
Yeah.
So maybe if you could hedge your interest rates on staked ETH or wrap staked ETH, which Euler has, you could kind of, that would be quite interesting.
That's a great point. We actually do have wrap staked ETH. So we added it not too long ago. And I mean, we've had some initial usage. I think the liquidity for staked ETH has been not so great lately. So that trade has, people have become more cognizant of the fact that like wrap staked ETH is not identical to Ethereum, which for a while people were treating them as effectively the same. But since you can't unwrap staked ETH, there really is it's more like a future than being the same. And there's a discount now that people are pricing into it. But I still think that there's certainly, I've certainly thought about it. Like, at a certain price, it's like, buying wrap staked ETH is great if you want to be exposed to ETH long term. and you don't mind waiting until the unlock.
Yeah, I don't see why people thought it was one to one. I mean, it's like a perpetual bond in a way. Like,
Yeah,
why should it be? And I think Lido guys communicated later on pretty well. Like, it's not supposed to be, but it's just we've incentivized one to one, but doesn't
right,
mean in the end it has to,
right.
which is pretty helpful because yeah, which is why it's trading a lot now, which is why there's lots of activity in order too, because now there's a two-way flow, which is pretty neat. But I definitely think there's interest in hedging interest there probably. So especially if you want to be big holders or something like, or like shorters, or like a lot of guys actually are shorting. Like what you could do is probably stake the normal way and short sell Lido's wrap stake
Hmm.
teeth, but you have this interest, the rate that you can't really hedge. Maybe there's a way to hedge that, and then you
Hmm.
just earn some crazy optionality, like a smart contract hack of Lido or something.
Oh, that's interesting.
Yeah,
Yeah, I mean, I think there's, really sort of based on your perspective on the future. I think there's lots of ways to trade stETH, and we're definitely trying to make those possible, and we have added it, and
yeah.
people are using it.
One other thing I think was interesting that people tell me is that like one product that hasn't really taken off yet, but I think has to find a way is trading fees from AMMs.
Hmm.
Like if you could, I mean, gelato tokens obviously help with fungibility and everything, and I guess they're becoming the underlying basis for like trading fees on DAI USDC, like DAI USDT. Maybe there were a way to kind of hedge your trading fees of some sort. Like it's kind of funny because, like, I don't know if you know the guy Guillaume Lambert who was trying to come up with like options markets on top of UniV3,
Hmm.
and he said basically the fees kind of are equivalent to volatility to shorting vol.
Hmm.
So if you're long LP, you're basically shorting vol. If you're like borrowing LP positions, you're kind of long vol. But there's no way to hedge your kind of your trading fees, i.e., like your like the cost of having that option. So maybe there's an idea maybe there to kind of hedge your trading fees somehow using yield protocol in the future. Just like I'm just crazy ideas.
Yeah,
In
I
the
think that's interesting. We actually, I think, thought about this problem a lot back in when we were first you know, planning to start yield, and almost considered like entirely pivoting to deal with issues like this. And honestly, the thing that I think the thing is honestly, most users, most LP providers are relatively passive, right?
Mm,
That is, they're putting assets that they already have, and LPing it, and aren't necessarily watching it that closely. Like there are some professionals, there are some people who are actively managing it, but I think for most cases that's not happening. So trying to build those products, I think there'll be a time for it, and I hope that time is soon. But I don't know if the market's ready for it yet. If so, I definitely think there are ways that yield could contribute, and it would be really cool. And we've definitely looked at like, can we add Uniswap v3 positions as collateral? We know we can do it. It takes maybe it takes a little bit of work. Um, and really the question was, like it's already pretty much a leverage product. Like, you already can get more leverage. Does that, is that marginal extra ability to get leverage, worth it enough to users to make it worthwhile to build?
yeah, I kind of agree. It needs a bit more time. This whole concept and also scalability of providing liquidity in AMMs needs to be kind of solved because it's not exactly not. It's not like most people make money on this. There needs to be some sort of improvement there. So I agree. Actually, speaking of just interest rates in TradFi, because we touched on that. Why do you think interest rates in TradFi and DeFi don't quite converge? Like they're not being arbed a bit. Like I feel like there's discrepancies if you look at the yield curve and stuff.
It's pretty fascinating, isn't
Yeah,
it?
yeah,
Like, I mean, I think that one of the interesting things is during the bull, interest rates in DeFi were essentially a lot higher than they were in TradFi. Now that we're in this bear market kind of situation, you look at interest rates on DeFi protocols, they're lower than maybe what you would see in traditional markets. It's kind of weird and shocking. I do think that they will be arbed over time. I mean, I think that they'll converge. I think that there's probably just a lack of infrastructure for doing that that's made it harder to do. I also think that like the users of DeFi are I don't say locked in, but like, they want to be in DeFi, like, and they're not as concerned that, interest rates are that low. Otherwise, I think if they were, they would just, you'd pull the money out and, you would take it back to trad fee, which to be fair has been happening. You've seen, the TVLs of all the major protocols go down, and you've seen sort of capital leave the ecosystem a little bit. But yeah, long term, I do think that they will converge, and I think that I could even see a situation where actually DeFi is maybe a leader, or maybe a first mover in terms of interest rates relative to the traditional markets.
We're going to move the U.S. government youth curve.
I don't know about that, but maybe just in terms of like, it may be, I think it's where a lot of very smart people are, and people who are maybe first movers, and so I think that's that may mean that like maybe they'll be a little bit more early acting relative to some traditional markets.
I just can't wait for the day when a 10-year US bond auction fails because of some DeFi stuff, because people, oh no, we got 12% in DeFi. We don't care.
That would be quite something.
Yeah. Let's talk a little bit about recent events. Like, so everything's been blown. Whoever's listening to this, everything's been blown up lately a bit. Like Celsius, 3AC, things are pretty much out of whack. Has that affected you in any way? Or if not, like what are you seeing?
Yeah, I mean, I think that's affected the entire ecosystem, right? Like we've definitely noticed yield protocol, like in terms of total usage, kind of like peaked in May, and then has like gone down a little bit. Not a ton, but certainly noticeably. And I think that along with the whole ecosystem. So I think that things are evolving, but in terms of like, we haven't, the protocol is healthy. It's fine. Everything's been running. We've been able to build. In terms of the founding team that I run, we're in a really healthy state. Like, so we, raised a Series A last year, during the bull market, and, put the money in the bank, and, have just been busy building. So, I think that actually, and my goal was like, I want to be, have us in a good situation so that when we enter a bear market, because there was always one coming. Like I've been through a lot of bear markets, in crypto. They just come, they go, they come, they go. And, so you just have to be ready for it. And so I was like, well, I want us to be in a good position for that. We raised money, and now it's just like, we're in a good position. We're going to keep hiring. We're going to keep growing. And it's really, really about, I think, being prepared for, okay, what's the next, levers or the next, drivers of growth in this ecosystem, because we want to be there to help make those great. And to improve users' experience, through fixed rate borrowing and lending. So for us, a bear market is just another set of opportunities to find new and interesting things to build for users.
Like, what do you think about this whole like situation with like CeFi versus DeFi? Because like I haven't been tracking all the flows and everything, but it seemed from the conversation I was having with people who are pretty knowledgeable, it seems like whatever was going on in CeFi was not transparent at all. Like what we saw in DeFi, these public addresses, what they've been doing has been a tiny fraction of what's been happening. Like most of these like deals with 3AC were basically CeFi lenders giving them some whatever ETH or USDC. Apparently they owe people so much money. That has not been trickling into DeFi as much from what I've seen. Like, what do you think that's the case? How come CeFi grew so big and DeFi has no clue?
Yeah, I mean, I think there's two really interesting things to me that we're learning from all of this. So I actually worked at a large market maker, Cumberland, which is a part of DRW, and so we were a part of the markets for borrowing and lending assets. We were primarily a borrower because it was a trading desk. So, you want to be able to trade some asset that you don't have. I mean, they had a large core position, and I was actually pretty involved with that. But, if there's an asset you want to trade, but you don't have, you have to go borrow it from somewhere. And so that was a very common thing that they would do. And there have sprung up a bunch of businesses that were happy to do that. Um, and sometimes, like in the case of like Celsius and some of these other protocols, they were using depositors funds, so people who had put into their app or whatever assets that they were then in turn lending out. Um, I would say that when I saw it, before I left, like, it was primarily collateralized. And even there were only really really big firms like the big trading firms that could get away with like not providing collateral. You had to have incredibly stellar credit, um, and they were the lenders were very careful about looking into you know the credit worthiness of the borrowers, and so there's always a lot of concern about like, okay, even for a big firm like Cumberland, what's your credit worthiness, and how are things working. And I think what I was surprised with is that seems to have changed over the course of the bull market. As people became less concerned about are the counterparties creditworthy, and would they survive a bear market. So that was one big surprise. Um, Another big surprise, I think, for me, was that how much DeFi has done, how it's done really well compared to CeFi, right? You have these firms, that are doing all these, they're doing crypto related things, but they're essentially centralized entities, and they're blowing up, and trading firms are blowing up. Meanwhile, there's been, well, I mean, besides like hacks and stuff, like a lot of the major DeFi protocols have been very, very good, right? Like Compound's done great, Aave's done great. There hasn't been any problems with Uniswap. There hasn't been, in many, many others. Yield protocol's been great. So we've survived this market volatility, with and I think part of it is the transparency. Like you can look into these protocols and you can see like, here's the assets they have. Here's what their balance sheets look like. Here's how they'll respond in an adverse situation. And here's the history. And that has just so outperformed these CeFi, products and institutions, that I've been really amazed. And so I think that it's been a real big win for DeFi. Unfortunately, from the outside world perspective, outside of crypto, like people can't tell the difference, right? They're like, Celsius is blowing up. DeFi has failed or something. And it's like, well, has it? Like that's not I wouldn't consider that truly a decentralized thing. It's a company basically. So, I think that this has been, I think, a really big comparative win for DeFi. That is like, the ability to sort of see how the protocol you're interacting with works, see the balance sheet, see the activity, and have comfort in how it will act in certain situations, has been so much better than these hidden deals that you don't know about, and these balance sheets you don't know much about, and these other centralized things that just have massively underperformed or blown up.
I kind of would like to believe that it's because we have a transparent ecosystem, as in like you can see what's going on chain. Part of me feels like there's just something structural about we have over collateralized lending
Mm-hmm.
in DeFi, and they do uncollateralized
Right.
lending.
Well, it's very risk averse. I mean, like, in DeFi and in that sense, like it's, um, I think that like, because it's such an adversarial environment, it's just so much more, uh, um, careful about like, okay, are we taking the appropriate steps to protect capital?
Yeah, I was just wondering. I think eventually firms just don't like posting a lot of collateral. It's just the truth. Like, I don't think they will always want to do it. So if you will have to get like Maple Finance or something like this, you probably need to have some sort of a ZK, because basically you don't want to review your positions either. That's why there's lack of transparency, because you as a market maker or trader, you don't want to show everyone what your balance sheet is doing, right? But you
Mm-hmm.
want them to conduct some credit checks.
Mm-hmm.
Maybe you'll have some in the future, something like firms on Aztec network or some privacy roll up where independent checkers will be able to see, sign off, but just not, or like gauge your positions without seeing it and sign off on it. And you can get that leverage if you want to. And I'm just speculating.
I mean, I
Basically,
think
yeah.
that's a great speculation because I think that zero knowledge proofs are like the technology that you would want and will need, right? Like, I mean, you're absolutely right. Like these DeFi protocols are collateralized, and market makers and others, they're going to want, they want credit facilities. They don't want to have to post capital for everything. It just makes it very hard to make money to do that. But I do think that like, we're building technologies that can make, feeling assured about a firm's capital much more possible. Because if even if you're a market maker and you have all this capital doing all these things, if you can, for example, build a zero knowledge proof that like identifies all of that capital and then says, hey, here's our assets minus our liabilities, and here's which is I guess your equity, right? Here's what our balance sheet looks like. But the person you give that zero knowledge proof to doesn't actually know all the details. They can just see the output of the calculation. I think that will be an incredible unlock of a new kind of way of doing credit. And I think one of the great things about crypto is that it has incentivized building those tools, right? Like, zero knowledge proofs were basically this kind of curiosity, I think, in computer science. But it was once you had this environment of cryptocurrency and Web3 where, building these tools were effectively incentivized by the ecosystem. You've just seen massive progress. And so I absolutely expect that will happen. That will build those tools, and that it will have. I think it'll help avoid a future repeat of these centralized financed institutions having the problems that we've seen.
Yeah, I think more importantly, bringing that privacy, while at the same time kind of accountability from CeFi into DeFi will allow these traders and all these flows to actually migrate into DeFi and then use these protocols like yields, like Notion or like Euler for in a much bigger way than now. Because as we've said, most of these flows are actually occurring somewhere out there, not in DeFi. We have no clue about them. Bringing all these flows to begin with would be pretty good for DeFi.
Yeah, absolutely.
Yeah. All right. Yeah. Thanks for coming over, by the way, to London and just having a chat with me. I'm sure we're going to catch up soon, probably at some conference or whatever. But I had a great time chatting with you.
It's been an absolute pleasure. Would love to come again.
Cool. Right. Thank you.
Thank you.